Get cracked. Wake up, motherfucker.
Satoshi Nakamoto, the inventor of Bitcoin, could be one of the richest people on Earth. But many years ago, Satoshi had disappeared, and with Bitcoin being woven into the fabric of the financial system, solidifying its role as digital gold, perhaps the question of Satoshi's identity was more pressing than ever. We should start with just an interview with you in Malta, if that sounds good to you.
Okay.
Who would have been working around the clock to introduce something like Bitcoin?
A lot of technical people will say, I could have done that. It's actually much harder than it looks.
Anyone competent enough to go do Bitcoin probably would be competent enough to not leave any traces.
Satoshi's got nothing to pick up by his stash.
Yeah, just 1 million Bitcoin. The currency derived from electricity might pose a real threat to the dollar.
3, 2, 1.
If it gained in popularity.
I'm the crazy prince that was talking about Bitcoin.
What we're trying to do is get parallel systems in place. Dollars, Bitcoin, pesos, Bitcoin, yen, Bitcoin.
If it looks like something could replace the US dollar as the world's reserve currency, three-letter agencies will do whatever they can to disrupt projects like Bitcoin.
I would rather buy shit that's worth something than buying crypto.
Bitcoin is about undermining the Federal Reserve, disintermediating the nation state.
It's not like Satoshi had some master plan.
Yeah, it's like you're in some sort of cult. You guys are having fun now.
Right? Satoshi left a lot of digital history.
When he left, he distributed control amongst different people in the community.
Were you the first person that Satoshi reached out to?
I believe so, yeah.
Best evidence of him being Satoshi.
Of not being Satoshi.
Being Satoshi.
What indication did you have that he was collaborating with the government?
If you dig deep enough, the inconsistencies will emerge.
Seems like he's responding.
I've been told Satoshi was a group of people.
I have to be careful at talking about that topic.
He checks a lot of boxes.
I will admit, you're pretty creative. You come with some crazy theories.
Here's what I think happened.
It's Bitcoin. Don't trust, verify.
All right. So tonight, I guess HBO is going to reveal who Satoshi is, the creator of Bitcoin. Now we'll see if we're going to believe what they're going to say. If you look at Martin Shkreli, he actually thinks HBO will legitimately tell us who Satoshi really is. So let's see what Martin Shkreli has to say about these things. Mr. Pharma Bro.
Excited to see the Satoshi reveal. That should be kind of interesting. You're going to say it's Nick Szabo? But I wonder if they give new evidence. I think they're going to say it's Nick. Nobody knows, maybe. I'm looking at Regeneron. It's out tomorrow, Alva. I was talking to a friend who's big in crypto. Nah, it's not going to be Len, apparently. Maybe, I don't know. We're gonna find out. Apparently it's the same guy figured out who QAnon was. So evidently he has some talent and track record in unmasking people. But some other dude said he knew the feds figured out who it was in 2013. He had a contact in government, and he said that they already knew in 2013. No, I think it's somebody outside of government, but I think that what's interesting is the feds didn't have interest in leaking it, and they leak everything. So I'm a little suspicious of that, right?
Yeah, I don't think he talks about it anymore from here, but you can get an idea. He thinks the documentary will reveal Satoshi. You can go to his YouTube channel, Real Martin Shkreli, SHKRELI. See the link I put in chat and on the screen, so you can watch his 6-hour, 10-hour live streams where he just types away and looks at 10K forms, autistically searching for terms, numbers, putting into a spreadsheet. So this is how you would do fundamental analysis. In this show, I just talk about charting. Okay, guys, we're not gonna go and spend hours combing through all these SEC reports just to find stuff. But here's his channel, and he specializes in pharmaceutical companies. So if you're really into pharmaceutical company gambling, that's probably something you might want to check out before you buy lottery tickets in some of those small speculative companies that are totally reliant on FDA approvals. So you're just flipping coins, man, and buying lottery tickets. But if you're going to do so, you might as well go to his channel and maybe copy some things from his live streams. He has, I think this is another dude. This is another channel. You can go to this one, Shkreli Planet. Okay, I put it on the screen. I put it in the chat. They take select clips from his long live streams. So if there's anything interesting, like this particular clip here, where he talks about the HBO documentary releasing tonight, we're going to see something real cool with Bitcoin. So I'll play the trailer again for you guys who missed it.
Satoshi Nakamoto, the inventor of Bitcoin, could be one of the richest people on Earth. But many years ago, Satoshi had disappeared, and with Bitcoin being woven into the fabric of the financial system, solidifying its role as digital gold, perhaps the question of Satoshi's identity was more pressing than ever.
We should start with just an interview with you in Malta, if that sounds good to you.
Okay.
Who would have been working around the clock to introduce something like Bitcoin?
A lot of technical people will say, I could have done that. It's actually much harder than it looks.
Anyone confident enough to go do Bitcoin probably would be confident enough to not leave any traces.
Satoshi's got nothing to pick up by his stash.
Yeah, just 1 million Bitcoin.
The currency derived from electricity might pose a real threat to the dollar
3, 2, 1.
if it gained in popularity.
I'm the crazy prince that was talking about Bitcoin.
What we're trying to do is get parallel systems in place. Dollars, Bitcoin, pesos, Bitcoin, yen, Bitcoin.
If it looks like something could replace the US dollar as the world's reserve currency, three-letter agencies will do whatever they can to disrupt projects like Bitcoin.
I would rather buy shit that's worth something than buying crypto.
Bitcoin is about undermining the Federal Reserve, disintermediating the nation state.
It's not like Satoshi had some master plan,
Yeah, it's like you're in some sort of cult. You guys are having fun now.
right?
Satoshi left a lot of digital history.
When he left, he distributed control amongst different people in the community.
Were you the first person that Satoshi reached out to?
I believe so, yeah.
Best evidence of him being Satoshi.
Of not being Satoshi.
Being Satoshi.
What indication did you have that he was collaborating with the government?
If you dig deep enough, the inconsistencies will emerge.
Seems like he's responding.
I've been told Satoshi was a group of people.
I have to be careful talking about that topic.
He checks a lot of boxes.
I will admit, you're pretty creative. You come with some crazy theories.
Here's what I think happened.
It's Bitcoin. Don't trust, verify.
Okay, here's a question. How do you successfully identify a contaminant candle? I'm guessing you're trying to say, like, how do you detect a spoofing? If somebody's making fake orders and stuff, trying to manipulate price. Well, the only way you're going to avoid it is you can't. There's always going to be people that will do this. This is why day trading would be hard. It'll be really hard to do that on a longer term time frame, which is why most people will tell you to invest. And also because the other thing that you can do is to, I think, essentially avoid markets that are illiquid, meaning that you're not buying stocks that have very little shares out in the open market, small float sizes. A containment candle. Okay, I misread that. I don't know what a containment candle is, so you're gonna have to define that for me. Anyway, let me see. Let's look at what the market had today. So let's look at our fun favorite, NVIDIA. Yesterday we had interesting news with SMCI, and the SMCI news spilt over into NVIDIA. So you saw yesterday's candle. Here, it touched the resistance that I set way back when from this candle, this large red candle in June, and which has been respected ever since. You see, again, another large red candle right through it before the next downtrend. And again, a failure to create any type of buying above it, creating another downtrend. And now we have successfully cleared it on that nice little news from SMCI. So let's look at SMCI. Super microcomputer. This company is very important to how people look at the supply and demand of GPUs going forward. So you notice this red candle here. It was on some news that the Department of Justice was looking into their accounting. Actually, I believe over here was when a short seller started saying they discovered some accounting oopsies. So they were already shorting at this point. The news dropped, and now we have a reversal on that news, on new demand. Okay. At what point after you set that resistance line? Okay, the breakout point is well, it looks to be here. It has to be confirmed though. We're gonna have to retest it. Okay, like once it clears here, you're gonna have to retest it. So you're gonna have some fighting in here, but I think it's gonna be too late. We are going to have earnings season coming again on starting Friday. So we're gonna have some noise coming back. We'll have CPI Thursday, PPI Friday. So 2 inflation reports coming out towards the end of the week. Any of those 3 things, JP Morgan earnings, PPI or CPI Thursday through Friday, could just reverse this whole thing. So right now we're just gonna fly free off of whatever good news the media can pump. I'm hoping it can pump a little more because I still have some leftover positions that I bought from here and here. I sold here, I bought back again here, and I rebought when it went here. I sold it again. So I'm hoping it can push this further, because if you see this SOXX, this is the semiconductor ETF, we have a lot of room to get to the old top back in July. So it's a lot looking a lot different from QQQ, all right? QQQ doesn't have much room to get to the old top, but semiconductors still has room to run, and that's what's leading the market right now. Let's see. SPY is already at a new high. See, it's struggling to make a newer high, but it's cupping now. So it's gonna try. It's definitely shaping up to try to push it. So I think it will try to push to a new high, trap some people up here buying last minute on greed, and then they'll flip the switch. They'll flip the switch. The media will go from good news to bad news, and that's it. It will just start going down. So that's how you're gonna do it. Yeah, I mean, that's why shorting is tough. You know, blacks. Yeah, you could try to put puts all over the place, and you'll get blown out the water the next day because you don't control the news. So that's why you hear Denison, CKJ3. They don't do anything with shorting. They rather just wait for dips and buy long because the machine is designed to go up. Now you can make a real good killing if you can time it perfectly, but you got to time it right. You time it wrong, you'll get burnt real bad. Like here, this would probably been a good signal, right? You saw two places where there were large significant drawdowns on semiconductors. You know that this sector is leading. So if you see a signal here, you're probably confident that the NASDAQ isn't going to follow through anymore. It's going to have a tougher time, right? So semiconductors look, yeah, a lot weaker. They're bigger red candles here than the QQQs, and you got this bigger one here. Then once you saw this, yeah, that's it. It's done. It's done. See, it looks way more significant when you look at the semiconductors because everything's driven by NVIDIA, right? You look at NVIDIA, you see it's not even going anywhere. It made a lower high here. You probably could just analyze all this. You could have said, like, I know NVIDIA is the leader of the semiconductors. I know semiconductors is the leader of the NASDAQ. And I know the NASDAQ is leading the S&P 500. Because as I told in the several streams ago, XLK, which is essentially the NASDAQ. This thing is essentially the NASDAQ. Okay, that's why I don't bother looking at it. But I told you guys the XLK makes 32%. Oh, let me look it up again. 32% of the S&P 500 in weight. Okay, so it's market cap weighted. So that means when NVIDIA grows so high, it starts dominating, and the rest of them too. The Magnificent Seven. So I could show a chart with the Magnificent Seven, and you can see right away how clearly how crazy it is. Because when you look at the S&P 500, you say, like, oh, that's not a bubble. That's not a bubble. Well, if I just stripped away all the other companies, right? So I just took 7 of those 500 companies. Look at how it moved from here, March to July. This is straight up parabolic. Now, if I just took this chart and showed it to you, you'll be like, what is that? Is that crypto? What is that, a penny stock? Yeah, it might as well be. Yeah, it might as well be. So when you see this, you probably would have been like, oh shit, the first big red candles I see on this weekly chart, it's time to short. So let's say I saw this red one and I saw this red one. So between July 8th to July 15th. And I think the market top was July 10th. So around there. So if I saw this, I would probably be safe to say that I'm willing to take a short here, right? Okay, yesterday I shorted the Chinese market. I didn't tell anyone because I could have had my ass handed to me. But I made it. I made it out. I didn't put a lot of money into it. I only made like I only put in like a few thousand, okay? I just said like that's all I'm gonna risk. If I lose that all my few thousands, I'm fine with it. But you know, look at that massive red candle. How did I know it was the right place to short? Well, I drew this chart, right? I thought like maybe it would stop here and pull back. I wasn't sure, but when it started blowing through it, I was like, okay. If you're gonna blow through it, you're gonna go to this orange one, and this orange line is essentially a very important line because it goes all the way back here, somewhere. I don't know, like here. So here, so this is one of the first areas of resistance in the 2008 recovery. So you know this, and then it tried to get above it for a few months here, or at least it looked like a good year. Yeah, almost a year, 6 months apparently, and then it fell down. So you know this area is significant. This is what they would call a axis line. Okay, it's an axis line because it's where most of the action would just pause before continuing up, and then pause before continuing down. So it's kind of a median, you would say. A median area where price would just react. Like, so you saw here when China's like things started going through COVID, this was acting as a support area because it started supporting here in March of 2020, went back up, then China tried to pop the bubble, it crashes back through, it did a little support, and then it just went through knife through butter through it. And all it did was it reacted, it went back up to it. Like when you saw this knife through butter action, and then you follow the first green candle here, this weekly candle here, you're like, oh man, it just ran right to it and just fell back. And then again, ran right to it and fell back. So I know that this area is significant. Now you're going to ask me why is that price so significant? You know, the whole market is ruled by derivatives, right? Futures, options. I'm sure people bought strikes and options way back ahead of time, and they tied it to those prices. So that's why when you start seeing price act so well around a certain price level, you have to assume that like, oh, some dude here bought a ton of options way back when and set it to this price. So when something happens close to it, you know, they'll probably do something. So this is something you should consider. It's also tied in with the quarterly thing, right? The quarterly effect where you have options that expire on the third week of the third month of the quarter. Same thing. You'll see weird things happen at certain prices around that. So pay attention to how price moves around a certain end of quarter, right? Or end of month. But usually end of quarter is more like has more power than the end of month. But yeah, end of month also has something. End of year too. End of year, definitely. End of the year. So again, we've done it. We hit here, we fell back. Now we went all the way here and we fell right back. I mean, you know, that's all I could do. I'm just guessing, right? I'm not, there's no guarantee. It could have just blown right through it and went all the way up some more this week. But I took a shot. I shorted there. But I'll tell you, there was another reason I shorted there. I saw something weird yesterday. And I think some people might have picked up on it. I'm not sure. Like, so in the US session, so after the Chinese market like pumped the this is why shorting China is so painful, because, or going long, like if you're trying to trade China, because the real effect happens overnight. So if you can't trade overnight, you know, you got to trade 24 hours essentially if you really want to trade China properly. And the only way you could do that is either you trade futures on the Chinese Hang Seng. So you have a Hong Kong brokerage account and can trade futures on their markets, or you have Robinhood, and Robinhood allows you to trade overnight on select ETFs. So you can trade certain Chinese stocks and ETFs 24 hours essentially on Robinhood. So that's why I recommended Robinhood as a brokerage. So even if you don't trust Robinhood and all this stuff, at least you have the option to trade overnight with Robinhood, because they allow you to be degenerate over there. Robinhood doesn't care. You want to gamble? Gamble. So if you want to gamble like the proper way on Chinese markets, yeah, you probably need to open a Robinhood, because I don't think any of you guys have the time, effort to get a Chinese wife or figure out how to open an account in Hong Kong or do some crazy shit just to do this kind of trading properly. Because I don't think there is a CME, a Chicago Mercantile Exchange product that trades China futures overnight. You can ask CKJ3, maybe he knows. I'm not a big futures guy, so I'm not sure myself, but I don't believe there is. Anyway, so I bring this up because you see this ETF yesterday was doing very well. It was trying to hold this support. So this is a 10-minute chart. You see the last minute, it started pumping. Looks kind of sketchy, and a huge volume towards the end too. It's just like, what the F? Who is buying this ETF towards the end? And the FXI is 30 large companies. So these generally are the boring companies of China, the state mandated companies. Essentially, like, imagine if the DMV or Section 8, HUD were companies, like, and put on the stock market. These are the type of companies they put on there. So Communist Party dominated, controlled entities. So for some reason, Americans, or who knows if they were Americans, they were buying this bad boy up. But if you look at the tech side of China, K-Web, so this is essentially the Chinese NASDAQ, it didn't really make a new high, did it? It had that pump at the end, but it opened and closed around the same area. So compare that to FXI. Like, FXI made a new high. So when I saw that divergence, I was getting skeptical. So when you look at K-Web, let's see what K-Web has. K-Web has Alibaba, right? So look at Alibaba though. In the morning, it made a huge dip before it recovered. So it spent the whole time trying to recover all its losses within the first couple hours. Let's look at another one, JD. It didn't even make it to the next high. Let's look at some trashy ones. Let's see. What's a trashy one? Temu, yeah, it doesn't look that good either. So this is Temu. Pinduoduo is the parent company of Temu. Billy. So this is like some AI tech. Yeah, not very good. Look at this strong opening red candle here in the open. So when you look at the tech companies that day, they didn't look good. They just they were barely holding on to whatever they were holding. So it gave me a pause, real suspicion here that something was up, right? So I decided, okay, the Hang Seng hit the resistance overnight, and it went over it. The second thing I saw was that during the US session, it pulled back crazy for the first 2 hours, and it didn't look like it was doing well, because if you look at the overall Hang Seng futures, you see this, it didn't even do well. So the only thing that was looking really good was this strange ETF effect where people were just buying the trashiest companies in China and pushing it up. And I was like, man, that makes no damn sense. If you were stimulating China, you just gotta believe that if you were a bull in the Chinese restart of their economy, it would be in tech stocks, not these communist run companies. they're essentially zombie companies that go nowhere. It doesn't matter if they make a profit or not. Essentially, they can always get padded up by the Chinese government, regardless if there was stimulus or not. So if you really believe the stimulus was going to the people of China, they would be buying tech stocks, because those companies that deals with day-to-day consumers in the real world would be going up if you were really bullish on it. And I'm not seeing it, right? So I said, F it. I'm going to short it. I'm going to take my shot. I'm going to short it. And I just used Yang. Okay, Yang is the one to use. So you buy Yang, it's the 3x inverse of the FXI. And I bought it down here near the close because I said, hey, look, it's so cheap now. I'll give it a shot. And boom, the next day it's already like 30-something%, and it was at like 40-something% at one point. I'm holding it still. I don't know if that was the wise choice. Maybe I should have sold it. Like taking a 40-something% gain in a day is good enough for most people, honestly, unless you're an options trader. So if you're an options trader, you probably would have, if you shorted it with an options, like selling a call or a put on FXI, or if God forbid you did a short put on Yang or Yin, it's like, oh yeah, you're a real degenerate here. Yin is the one that follows FXI. So you should note this: Yin, YINN. Okay, YINN is 3x FXI. Okay, so it goes 3 times FXI. Roughly, it's not ideal. Okay, and then Yang is 3x. Yeah, negative 3x. I'll put negative 3x. So it's inverse. Okay, FXI inverse. Okay, just to be clear. Just to be clear, make sure you guys understand. So Yang is what you want to use to short. Yin is what you want to do for if you're long. All right. Maybe it was a bad move to hold the Yang. Maybe I should flip to Yin now. I don't know. It's hard to tell. But that's why trading this type of environment is, I don't recommend it. I'm a conservative person. But like I said, if you got a Robinhood account, you can do overnight. You want to be a degenerate? Yeah, you could do it this way. Because options, you can't do after hours. You can only do during. So this is a real benefit of Robinhood. If you got to do something degenerate in China, options is way more dangerous here. Because you don't know what China's going to do. Like if China moves against you, you can't dump it. You can't do nothing with those options until the next day when the market opens. You can't do pre-market. So you got to wait so many hours before you could trade. And by that time, yeah, you're boned. Your options are probably worthless and you can't do crap about it. You just got to suck up the loss or just hold it until it can recover or something, which is not something you want to do, honestly. So go talk to an options trader about this. Go talk to Denison. He probably has some, but the other way is futures. And I'm just not sure if China has the Hang Seng futures in the US CME, Chicago Mercantile Exchange. So something to look at. You can look it up. Okay, that's enough about China here. And I covered NVIDIA and SMCI. So I'm going to do the news articles now. Let's do the news articles. Excuse me. Yeah. So I put everything in the list. Hopefully I can find it. I can't find that whole thing at all. Man, I got so many tabs. I opened it in a new window though. Man, that's strange. Let's see if it works now. StreamYards is kind of funny sometimes. Okay, it sees it now. All right. Let's go back here. I'm not going to talk about the water stuff again. Let's just look at SMCI. So Supermicro says it's shipping 100,000 GPUs per quarter. Stock jumps. Oh, thanks. This was yesterday, October 7th. Supermicro Computer SMCI rallied Monday after the server company announced it's shipping more than 100,000 graphics processing units per quarter. SMCI stock rose 15.8% to close at 47.74. So it essentially erased all its gains from the earlier bad news of the DOJ doing its investigation. So let me see if I have that article right here. So it's September 26th, 2024. U.S. Justice Department probes Supermicro Computer, Wall Street Journal reports. So it's investigating them, citing people familiar with the matter, sending the AI server market, server makers shares down 5%. Supermicro Computer had earlier this month denied claims made in a report by short seller Hindenburg Research, saying it contained false or inaccurate statements about the server maker. Hindenburg in August disclosed a short position in Supermicro and alleged accounting manipulation. Citing evidence of undisclosed related party transactions and failure to abide by export controls. You know, Supermicro had problems with this before. I mean, I know of them actually. When I was working in the industry, we had to get boards from them. So my company had multiple departments. One department needed to use them for their server racks. So they always had tons of those boxes that said Supermicro. And that's one of the reasons I bought their stock just before the NVIDIA stuff started pumping it. I didn't know that NVIDIA stuff was like gonna happen. I just knew they were an important company. So that's why I always tell people, you go to work, like Rashu, he works and he knew that ASTS was like something he was working on. And he didn't actually buy their stock. He was working on projects that was dealing with their work to put up satellites. And I think if he put one and one together, right, he would have been like, wait a minute, why are we doing so much work for this ASTS company? Like, I would have bought that. Oh, yeah, Jay Rillo. So you should look at the last stream I did. I talked a lot about commodities, a little bit, not particularly about silver or gold, but I am bullish on silver and gold. And it's not necessarily any hedge on a recession, you know. So a lot of people think like these things have to move up in a recession. Not necessarily. Sometimes they do, but they can also move up alongside with the stock market. So there are times when silver and gold will pump with the stock market, pump with bonds, because, you know, one of the things that silver and gold suggest, because one, gold doesn't pay a dividend, right? It doesn't pay interest, a coupon like a bond or a stock. So when in cases where right now we're cutting interest rates in the US market, gold starts looking more attractive, also for the fact that it leads inflation. So if you think the Fed cutting rates will prolong high inflationary periods, then even if we don't really get into a recession, because we technically hit a recession like last year, you know, but it doesn't matter because the economy is still running. We just had a slow down in growth. So it depends on the type of recession. If you're talking about 2007, 2008 scenario, yeah, that's different. But the big time that gold was really moving up was during the George Bush era. And at that point, a lot of commodities were moving up and the stocks were moving sideways, going nowhere. So gold just looked like a alternative for that. And we are entering into a commodities boom, and silver is, you know, an industrial metal used everywhere. So whether you believe in AI, Green New Deal, Bitcoin, it doesn't matter. any of those three, and if you're lucky, all of those three will be put into play. And at that point, yeah, silver will move up alongside utility stocks and all the other things. And I see the commodities moving up also because China has stimulated their own markets, and that's why you see copper pumping. Once you see copper pumping, that's it. So now we're in a waiting mode where copper will translate to silver, will translate to gold. All three should be pumping together very, very cleanly, probably next year. I wouldn't say, like, if you missed buying, because I bought early already, like last year when it was like 1,300, 1,400 for gold. So like if you bought physical gold, yeah, that's one way. So if you missed that, like right now, you should just be buying paper, silver, and gold. And I discussed maybe 2 streams ago on a Saturday, the Saturday one, All Seeing Guy and I were talking about the ETF PHYS, Fizz. Yeah, Fizz and P-Silv. So you can buy paper, gold, and silver pretty easily. So you can trade it, because right now, like, yeah, you can buy a ton of physical, but the thing is you can't offload it once it reaches like a really big high. Like, I mean, I don't know how the market will turn out. It's really easy to sell like gold in Chinese jewelry stores, Vietnamese jewelry stores. That's how I do it. But silver, I'm kind of skeptical about, like, how you're gonna offload a ton of silver, because yeah, Asians are not gonna take the silver. Like, if Asians took all that silver, yeah, I would buy a ton of silver too, but it's really only an American thing. And if nobody wants to buy your silver, and you convert it back to cash, so you can get the cash to buy like a house per se. And even then, you got all this cash, like how would you move it into a bank to, like, I don't know, unless you just hand off the cash to someone. Yeah, see, that's the problem. You see, this is why things are so difficult. When you just have tons of silver and cash on hand with you, like, the government just looks at you like you're a criminal, right? And that's why I was talking to All Seeing Guy. It's just not really practical to have it. So that's why it's better to use the, like, I know a lot of these gold and silver bugs, they're like, oh, it's the end of the world, you should buy physical and this and that. I'm like, I'm not down, bro. We'll get to the end of the world when we get to it. It just ain't happening right now. And I'd rather have liquid cash. So if I'm going to transfer between gold and silver into cash, back from cash, like, this is the way to go with these 2 ETFs. Okay, so here we go. I'll put it on the screen. PHYS and PSLV. The reason why I recommend those is because if you hold them long term, you don't get taxed the physical collectible rate. So selling and buying of art, selling and buying of Pokemon cards, baseball cards, statues, vases, like just anything physical, you're taxed at a higher rate on the long-term scale. Okay, so that's the real problem. Now, if you don't care about that and you just do short-term, then I think the best thing would be for you to use futures. So you can trade on the futures for gold and silver. That's a little bit more complicated, but the tax benefits of using futures is really nice. So it doesn't matter what time you buy or sell, you are taxed 60% of your holdings long-term and 40% short-term. So that means any gain you make, it's automatically split into 2. So you could day trade gold and silver, and you would still be taxed 60% of that gain long term. So there are real advantages to looking at other instruments to try to handle what gold and silver does, because commodities, they move up very quickly, right? So you never know. It could be that it'll spike up in 1 month. Like, let's say, assume next year, February or April or something like that. And that's it. Once it spikes up and shoots up, it just crashes all the way back down. That's how commodities always works. And that's why hate telling people to rely on commodities. Like, let me just show this. So look at oil today, all right? This is why I just hate dealing with commodities in general, because you're always on your edge. I mean, the seat of your pants. You just don't know what's gonna happen. Like, let's see here. Let's look at oil. Yeah, oil was doing so nice like yesterday, overnight, and then all of a sudden it's like, yeah, I'm gonna crap out now. You see that? It's like, and I'm trying to play natural gas, and you know, it's so annoying too. It just does this kind of stuff. It likes to make these peaks and just like throws up. It's just like barfs everything right back the next day like this when it hits some kind of major resistance. So I suspect gold and silver, it will happen like this. It will have a moment where gold and silver is breaking through all sorts of resistances in 1 month. And then the next week, all of a sudden, it's just nothing. Everyone starts selling like crazy. So as I said, at various points in time on these streams, commodities futures are like the crypto of the boomers, you know. So let's see. I use this ETF, oil U. So I use this. So this is the ETF for oil companies, and I 3x it. So this is a leveraged one. So I sold it here on Friday or Thursday. I think I sold Thursday. So I missed out on some gains. So I probably missed out on 3 to 5% more gains here because I sold it here on Friday. But I missed this loss here today because all of a sudden it just crapped out, right? Oil just crapped out. So all the oil companies just started crapping out. That's why, man, commodities is so fickle. Really, really painful. Like if you really want them to keep a trend, it's just hard. Very hard. Now let's look at your uranium. Uranium is one of those things that I'm looking at. All-seeing guy, I think, bought here at the top, you know, of one of those uranium miners, CCJ. See, so he bought here. I think he's fine now. Like, it made it back, but he had to suffer through this. See, it's just because you're holding a company that relies on a commodity. Commodities just like in 1 second it just becomes crap, and they don't go down slowly. They just immediately waterfall down. You know, like that. So that's why this happens. I think lithium. Yeah, lithium. Look at this. Yeah, lithium used to be the hot boy, right? And it just completely collapsed. But now it's the hot boy again. Now that China's pumping it. So I'm looking at PLL. The last 2 days, yesterday and Friday. Oh man, look at that. Really good. So Piedmont Lithium, 20% here, 16%. And I was talking in some of the articles about like North Carolina. So it has some mines in North Carolina. Something interesting about that North Carolina stuff right now. And I still haven't gotten to the Crucible stories with the refined quartz and all that. That's on my to-do list. I don't think I can do it today. But right now, I don't know if it's because of China that it went down 8% from this top, but I was really eyeing this exuberance here. This probably is short selling, because if you look at other lithium miners, SGML, they don't look that crazy. LAC, yeah, you see that? It wasn't moving up like PLL. And this is what False was trying to tell me to look at. Like, this chart was so ugly out of all the lithium miners. Argentina, okay. LAAC, Lithium Americas Corporation. It's moved up pretty nicely, but like if you look at it, I think you gotta be holding your horses here. Wait a while. Let this thing cool off, okay, before we consider it. I'll talk about Palantir next. I mean, Palantir is one of our favorites, and I'll use this as an example of one of our lessons today. So I'm not gonna do it right now. I'm just going to go back to the article. So let's go back to Supermicro. Remember, SMCI. Back in August 27th, Hindenburg takes aim at AI server maker Supermicro with short position. So alleged accounting manipulation at the AI server maker, the latest by the short seller whose reports have rocked several high-profile companies. The report pits the short seller, which has tussled with billionaire investor Carl Icahn and India's Gautam Adani, against a server maker that has been one of the biggest winners of the generative artificial intelligence boom. So let's see. This was August 27th. Yeah, I think that was when SMCI made its next leg down. Hindenburg said it found evidence of undisclosed related party transactions, failure to abide by export controls, among other issues, citing an investigation that included interviews with former senior employees and litigation records. Supermicro, benefited as an early mover, but still faces significant accounting, governance, and compliance issues, and offers an inferior product and service now being eroded away by more credible competition. Really? Well, it just had a new order for 100,000 boards for CPUs. So, I mean, GPUs. I don't think it was that bad. Oh, yeah, maybe they cheated on their books a little bit, but, that'll be quickly forgotten. Wall Street forgives very quickly. Greed always trumps fear eventually, right? Close ties with chip giant NVIDIA have allowed Supermicro, known for its liquid cooling technology. So another article that I talked about last time, the last two times actually, was about water. So we should look at water companies, man. Anything with AI will need electricity and water. Those things are going to be burning hot. All right. So we're going to need a lot of water to power this stuff. Though revenue has surged, margins have taken a hit recently due to the rising cost of server production and pricing pressures from rivals, including Dell. Analysts have flagged the company's hefty spending on supporting new generation of AI chips, including those sold by NVIDIA. The company's shares have also come under pressure in recent months on rising worries that big tech could scale back AI spending due to slow payoffs from the billions of dollars they are investing in the technology. Okay. Now, let's go back to the current article. I'm not going to go to this one yet. Let's see. Blah, 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 blah. Supermicro recently deployed the GPUs with liquid solution for some of the largest AI factories ever built, the company said in a statement. The San Jose, California-based company said it is currently shipping over 100,000 GPUs per quarter. Oh, man, that's a lot, right? So this was yesterday. Supermicro continues to innovate, delivering full data center plug-and-play rack-scale liquid cooling solutions. The stock rally marked a huge comeback for SMCI stock, which crashed last month on report that it was a target of the Justice Department investigation. So now, it didn't do good today, all right? So that pump yesterday was temporary. I'm still going to say that there's a better price to buy it at. So let's look at the price. Let's look at the price we should be targeting. So if the stock market is going to go down starting this Friday, where should I buy that stock? Okay. Where should I buy it? Okay. So here's our Wyckoff schematic here. You see that? Now you see this, right? That? See that? You see that? You see that? All right. So we're moving up, we're moving down. Like, I don't know if we're in phase E yet, or this is still phase D. If we're done, then I guess we're done. We don't need to wait for it to buy. But if we're not done, then I assume between 25 and 35 is where I will buy it again. Because when I bought this company, it was probably around here. I sold too early, though. I think I sold it here, somewhere at the early parts, when it was on its early move up. So, you know, you're never going to be perfect about this stuff. And I'm getting older. I'm going to be more conservative. I'm not going to be a risk taker like some of you guys will. But if you're younger, you have to take more risk if you want to make that cheddar, right? That's the problem. Everyone has a different life situation. So whatever I tell you to do is only through techniques. And from those techniques, you're going to have to base that on the risk you're going to take. And I think I am going to talk about it at the end of this stream. We're going to have a lesson on risk management, a little intro. There's so many ways to do risk management. I'm just going to introduce you to the idea of like, how would you measure risk, right? So let's look here. So August, right? August 27th. This was where the Hindenburg short attack was, when they said, oh, these guys are accounting frauds. So they crashed the stock from here to here, 62 to 40. And you have to remember, they had a split recently. So this was 10 to 1. So actually, it was like $620 to $380 or something like that at one point. And then the DOJ comes out with their thing, or the media reports that the DOJ was right here. It crashed it again, right back to here. This support, right? And guess what? If we look at this area, why is this area so important? Probably because this last green candle here, this big green candle, this was where it finally escaped this base. You see that? So I hope you see it. Like, this is a base, an accumulation being built before it ran up. Now this here, the top of this, is distribution. Okay, that's what I was trying to tell you guys what it was. I was trying to tell you what this was looking at. This was making weaker highs. It couldn't even clear this last blue. Look at that. It barely even got to here, to the top of that purple line that I drew up there, because this was a gap. And then finally it made its last ditch effort here, and then it finally gave up and collapsed all the way down back to here. So now move back down to the original range back in August 23, or it's going to hold here and move back up. I can't tell you that. I think the only way this will panic sell lower, because earnings is on Tuesday, October 29th for SMCI. That's quite a whiles away. That's a lot of days away. We have a lot of stuff that will happen before then. We'll have earnings for JP Morgan on the 11th. We'll have options expirations on the 18th. We're going to go close to elections. I'm sure people are going to pump some scary news to shake people out. I don't know. So I wouldn't buy it here, honestly, as a conservative type of person that I am. But hey, you know, if you want to start buying as it drops, yeah, you can go ahead. But just be aware that if you're buying now, you better have more money to buy it down lower when it comes down. But yes, SMCI is something I put on my watch list. Intel is another one people keep asking me about. Like, look at Intel. Not bad. It's trying to do its little thing, recover a little bit here. But yeah, it's hard to say. I mean, it is a good price to buy it, even at 24 at this point. But if we look back, it could try to do it, right? It could try to hit its 2008 lows. I don't know. If there's a panic in the market later on this month, just don't get caught. Like, if you buy now or you bought before, you just have to be willing to pay more later when it drops. It's just the game. You can't time things perfectly. Nah, you're never gonna get the bottom, right? So if you're willing to buy early, then you're gonna have to willing to pay the loss or to cover the loss, basically. Or you're gonna have to wait and for it to recover and say like, oh, okay, it's safe to buy. But if you do that, you're gonna have to buy at a higher price than the low. You're gonna have to accept that cost. That's just how it goes. Okay, let's go back to the articles. So I think we're done with Supermicro. We don't need that anymore. Now let's look at weight loss. Weight loss. This is so interesting to me because Universal Jones was talking about Hims. I know Hims. Hims is an interesting company, at least from a stock point of view. And, you know, also he was interested in generic versions of Ozempic, right? So let's look at this article here. August 29th, 2024. Hims and Hers, one of the largest publicly traded telehealth companies in the country, has supercharged its business in the last several months by offering compounded versions of the patented weight loss drugs known as GLP-1. It's staking its future on the drugs, with plans to continue selling compounding GLP-1s even when shortages of the versions approved by regulators come to an end. A strategy that policy experts say could land the company in court. Broadly speaking, compounders, I really don't understand what this word means. Compounders, like in the sense of the drugs, are allowed to sell versions of FDA-approved drugs when those drugs are in shortage. That has regularly been the case lately with GLP-1 drugs marketed by Novo Nordisk and Eli Lilly. And I talked about those two companies. Lilly is one of my favorites. I love Eli Lilly, like as a big pharmaceutical company. That's the one that just perfectly gets gained. So if you're interested in constructing a portfolio with winners, like you got to have Lilly as one of your healthcare, like a large portion of your healthcare sector. You're just going to have to overweight that one. Hims, as the company is often referred to, has become one of the most prominent public faces of compounded semaglutide. Okay, whatever. Offering it in more than 30 states and spending nearly $145 million in a single quarter on marketing. Damn. Which includes injections with the same active ingredient as Ozempic and Wegovy. So Ozempic and Wegovy are the weight loss drugs that Novo Nordisk and Eli Lilly sell respectively. And these were actually diabetes medication. Okay, so you guys, they were originally diabetes medication and now it's just weight loss drugs. So pretty important. And this article requires me to pay, so I can't give you the rest of it. Sorry to say. So I can read this other one. This is back in October 3, right? 2024. So that's recent, actually, compared to the other one. FDA warns compounding pharmacies on weight loss drugs. A surge of alternatives to newly popular weight loss drugs is facing its biggest test yet after the FDA warned companies against skirting regulatory standards to put them on the market now that shortages are waning. All right. Widespread shortages of GLP-1 drugs such as Novo Nordisk Ozempic and Wegovy and Eli Lilly's Zepbound and Mounjaro have triggered a rush of companies seeking to exploit a loophole that allows them to sell compounded versions of the injection. See, I didn't know this. So this is the first time I've been reading these articles to you guys. I'm reading it myself. So this is really important, I think, knowing what compounded means. The FDA on Wednesday took tirzepatide injections, Mounjaro and Zepbound, off its official drug shortage list and issued a reminder that compounded drugs must meet conditions to qualify for exemptions to be sold to the public. Ooh. Pharmacies must immediately cease preparing and dispensing compounded copies of Mounjaro and Zepbound. Oh. So these companies that do compounded work here, so they can sell like bootleg versions of the drug when there's shortages. Very interesting. So the impact. Telehealth platform Hims & Hers, one of the most prominent companies to offer compounded GLP-1 drugs, saw its stock close down 9.6% Thursday. Hims doesn't actually offer compounded tirzepatide. It offers compounded versions of semaglutide. The key ingredient to Novo Nordisk was... Oh, man. All right. I think you get the idea. I'm not going to talk about all this stuff right here. But, yeah. Very interesting. I think this article definitely I'll put in the chat. You guys can see it, so you guys can look at it. So let's look at this. This is the response by Hims & Hers. Hims & Hers Health asserts demand for its compounded weight loss drug. All right. To continue despite resolved supply shortages. So this is October 4th, one day after that other article. Thursday, the FDA determined the shortage of Eli Lilly & Co.'s tirzepatide injection glucogen-like peptide 1 medication has been resolved. The U.S. health regulator reminded compounders of the legal restrictions on making copies of FDA-approved drugs. Oh, I see. Despite semaglutide being the active ingredient of Hims & Hers compounded GLP-1 product, a Truist analyst notes that the recent FDA commentary has reignited investor concerns about the long-term viability of compounded GLP-1 treatments once the supply shortage ends. Truist consumer survey reveals that approximately 10% of consumers currently use compounded GLP-1 medications, while 14% are on branded versions. Many people opting for compounded GLP-1 cite its lower cost as the main reason. Okay. How much lower? Yeah. Hims & Hers' assertion that demand for its weight loss service could remain strong even after supply shortages ease, as long as the company operates within compounding regulations and respect branded drug patents. Okay. Yeah, this is going to be interesting. Interesting. So, based on third quarter card data analyst, the analyst notes that Hims & Hers Health third quarter 2024 revenue is expected to exceed the company's guidance range of $375 million to $380 million by approximately $5 million, $10 million. The analyst also highlights that Hims & Hers average transaction price was up 14% sequentially at $126.9 versus $111. Net orders for quarter 3 2024 increased 3% sequentially from second quarter 2024. Truist maintains a hold rating with price target of $23. All right, we're done with that one. Here's another article. So I'm just going to go through all these articles here. Hims & Hers stock tanks after FDA says competitor Eli Lilly weight loss shortage is over. Yeah, we already know that. Blah, blah, blah. Okay, let's see if there's new information here. Drugs prescribed for weight loss, such as Mounjaro, Ozempic, Wegovy, and Zepbound, have been popular, expensive, and in short supply. To meet demand, health providers like Hims & Hers has jumped on the opportunity to provide compounded versions of the weight loss medication, which haven't been in the market long enough to have generic equivalents. Okay. Yeah, they don't say anything about the price in this article. I'm really curious about the price. The removal from the shortage list could effectively bar the commercial production of knockoff terzepatide products, according to Wall Street Journal. It is illegal for manufacturers to produce compounded drugs that are identical or nearly identical to the FDA-approved drug unless approved drug is on the FDA's drug shortage list, blah, blah, blah. So the thing with Hims is that the weight loss injection does not use terzepatide. Its injection is a compounded form of semaglutide, the medicine sold by Novo Nordisk as Ozempic and Wegovy, which remains on the FDA's shortage list. So, okay. So if Ozempic's still on the shortage list, Hims can keep selling these bootleg drugs. Fine, just fine. That's what that's saying. Now, here we go. August 29th. So this is an older one. I think this one probably has the price. I think it does. One of these articles has a price. Here we go. A deeper look at Eli Lilly's lauded announcement on cheaper obesity drugs. And in more GLP-1 news, Eli Lilly garnered widespread praise Tuesday for launching discounted versions of its blockbuster obesity drug Zepbound. It used to only be available as an injectable pen at the steep price of $1,060 per month. Oh, well, just $1,060 per month. You can afford that, right, guys? Now, starter doses in vials will be available at almost half the price. So we at least know what the prices probably are. Now, I don't know what Hims and Hers are charging for theirs. So we'll see. Okay, let's go back. I think this is the press release that... Okay, let's see if they got the price here on this press release. So Hims and Hers injection. All right, let's see. So they say that the pricing for weight loss medication starts as low as $79 per month for oral medication and $199 per month for compounded GLP injections. Well. That beats $1,000. And, Eli Lilly said they were going to cut that in half, $500. So they're still winning. So Him and Hers, still a cheap alternative. So yeah, so now that we've covered all that news, let's look at the chart. Let's look at the chart of Him and Hers. Very interesting chart we have here. See a nice cup here. We return. Now we're making a base. So we hit this initial IPO price, or who knows what this was. Maybe it was a SPAC company when it opened. But you see, back in October to February 2021, it reached a peak. That probably coincides with the peak of biotech companies. If you look at biotech companies, they pretty much are the same. So you look at the biotech ETF XBI. Look at that. Look at that. I just plotted the ETF XBI. Look at that. Perfect. So the whole sector hit a peak and then dropped, and Hims has been following. But right here, since May of 2022, Hims has been outperforming the rest of the XBI sector. All right. So this is going to be an interesting chart to look at for the future. I think, yeah, you should put this on your watch list. HIMS is a ticker symbol. We see now that it's trying to make a new high up here. We're going to, I think it's going to build this range a little bit more. We're going to fill it up a little bit more. And yeah, I would definitely be a buyer if it touched 15 or 13 again. I mean, I don't know. If the stock market really drops, I could see it going down to 11. You know, there's no guarantee it will drop that low. But yeah, just put that on your watch list. Something to buy. Something to look at. Anyway, I'll take this away. Now, let's go back to looking at water. Water for AI. So we only got about an hour. Yeah, I can keep covering it. I'll do the lesson later on, near the third hour of this. So that's the weight lesson. I don't need that. So water stocks. Okay. So there's a lot of water stocks here. And I think if you guys did not watch the previous streams, I'll repeat this one. As use of AI soars, so does energy and water it requires. Okay. That's the thing. Generative artificial intelligence uses massive amounts of energy for computation and data storage and millions of gallons of water to cool the equipment at data centers. All right. So I'm going to skip through this. You can watch the previous streams. I talked about this. So it's data centers electricity consumption in 2026 is projected to reach 1,000 terawatts, roughly Japan's total consumption. Okay. Google's data centers use 20% more water in 2022 than 2021, while Microsoft's water use rose by 34%. So yeah, you're gonna need a lot of water. In 2022, Ren says, Google's data centers consumed about 5 billion gallons, nearly 20 billion liters of fresh water for cooling. Consumptive use does not include water that's run through a building and then returned to its source. In Chile and Uruguay, protests have erupted over planned data centers that would tap drinking water reservoirs. So we are at the beginning of the water wars. Quite so. And, well, it's time to profit off of it, right? As access to clean water becomes ever more scarce, a thematic investment opportunity arises. Water contributes significantly to industries such as agriculture, food production, and even semiconductor manufacturing. It is a scant resource without many alternatives. Given the central role it plays in many industries, the case for investing in water is strengthened by its increasing demand and unstable supply. In acknowledgement of World Water Day on March 22nd, we take stock of water investment solutions available to U.S. investors. So here we are. We got some here. So you can take a screenshot of this. I'll take this down. Yeah, go ahead, take a screenshot. And I'll put the link up here so you guys can look at it yourself. So there's a lot of ETFs that track water. Now let's look at the common ones I see. So it looks like these are the common ones. American Waterworks, AWK. Advanced Draining Systems, WMS. Xylem, XYL, Pentar, PLC, PNR, and Ecolab, ECL. So those are the companies here. I'll put away so you can see it. So you can take a screenshot of that. So those are the common stocks that are held by these water funds. So you can look at it yourself. You know, this is something I will definitely be looking at. And I think that's it. We covered everything here. Definitely. And I'll look at 2 of those water stocks. So let's see. This one's my favorite. CWCO. This one I love to trade. I mean, if you got here in March 2020 at like $10, like $9 to $10, yeah, you could have sold it at 37 up here at the peak. I mean, 30 to 37, that's pretty good from 9. Oh man, see that? Perfect, right? So the resistance set in August 2007, it hit it and it dropped back down. So my question to you guys is that, is this whole thing here a base? So if it's pulling back now, maybe it's going to hold like 20 to 24 and it's ready to attack 37 again. The next try it goes up and get out of there. So yeah, CWCO, this is Consolidated Water Company. Okay. So definitely put that on your watch list. I am very interested in seeing how this develops in October. I may be buying a ton of this stock because I like the way it looks right now. I like the way it looks. When you have a base that goes from 2007 to 2024, man, if it breaks out, whoo, this thing could be flying. And now we know that AI needs water, right? So there you go. Here's the ETF. ETFO. FHO. It has a nice trend. Nothing too spectacular. Looks kind of boring. But if you're into ETFs, you know, it's definitely something to consider. Like compared to XLU. XLU is generally electricity and natural gas utilities. They have probably some water utilities in there, but not too much. So if you think water is the one that you should be looking at more heavily, then you would buy the ETF here, FHO, and underweight XLU. So we'll talk about this more, where we discuss, like, if I'm going to construct a portfolio of ETFs, like I'm just lazy. I don't have time to look at a billion companies. Like, let's say you're that type of person. We can still try to do things where you have ETFs and try to do it. And CKJ3 has mentioned that he likes ETFs in the sense that he uses leaps. So if you do options, you can leverage them using leaps. So if you really think some sector is really going to have a big boom time, yeah, you'll buy an option 1 year out and try to do that. Do you have let's see. Do you have a well-performing treasury bond or bonds we recommend if we experience after the elections? Right now, well, okay, we can segue into that right now, actually. Like, there are bond ETFs. Usually, if you want to buy bonds from the US government directly, you use the treasurydirect.gov website. But you can use your broker to try to buy bonds, or you can use ETFs to buy bonds. So TLT is a 20-year to 30-year ETF, bond ETF. You can have a 10-year bond ETF. You can have a 5-year note ETF. You know, there's many options for you. And you have treasury bills that you can buy ETF if you don't want to buy them directly. I buy them directly because I'm in a blue state. My parents are in a blue state. So if you're in a blue state with a high income tax, you want to buy them directly from the government, because then you don't need to pay those taxes in your state income statement. So if you're paying state income, high state income, you deduct that. So yeah, I told Blacks about it. I mean, he lives in Texas though. He doesn't need to do that. But, you know, just for your information, yeah, you can buy bonds directly. But if you don't want to buy bonds directly and you want to trade, there's alternatives such as those ETFs, or you can buy TMF. TMF is 3 times the movement of TLT. So you see that TLT has been going down since the late 2000s, and when the interest rates started being hiked starting November 2021, you see it dropping. Now, there's a good chance, you know, TLT can move up to 122. That's a 20% gain from that's over 20% gain from $95 a share. So a lot of people, they just look at bonds, they think like, oh, I'm just going to get coupons or something, so I'm just going to get the interest rate. Well, you know, not you also get the price. So price can go up for bonds. If there's a lot of demand for bonds, the price will go up. So it doesn't necessarily only have to be like, oh, the interest rate you get when you bought the bond, but later in time, when interest rates for current bonds are falling, your old bonds that are paying high interest rates start looking more attractive. So that's when you can sell your old bonds to the market at a higher price. So that's what this represents. So if you bought bonds at this interest rate here when it was $84 in TLT, so let's look at the 30-year interest rate. So interest rate was hit a peak for 30-year bonds at 5%. So let's say I was very shrewd and I bought my bonds up here and I got about 5% interest rate for 30-year bond. Very good price. Now you can look at the price of the bond as a proxy using the ETF TLT. So there's a price associated with that bond. So now that interest rates have decreased and price has risen for my bonds that I bought here, I can sell those bonds at a higher price. I could keep waiting and sell them up here. Now, of course, you know, 5% for a 30-year bond is really good. Something that you probably would not sell like readily. You would probably still keep them, but hey, if somebody really was willing to pay a lot of money for those bonds, you're going to want to sell them. So that's what this ETF tries to track. Okay, I hope you understand what I'm saying here. So price is inverse the interest rate. So when interest rates goes up, the price goes down, and when interest rates go down, the price goes up, because what you paid for that bond is valued at a better price when the current bond interest rates are dropping. All right, so that's what that means. I think John and I have explained that multiple times in different ways in the streams. We probably should clip all those out. Yeah. In any case, TMF is a degenerate way of doing this. TMF won't give you the dividend though. So you won't get the dividend from owning a bond like you would normally. But let's say you are a gambler and you think interest rates are going to drop like crazy. If you think so, and you don't want to buy bonds because they're annoying to deal with, you can buy this ETF, TMF, and it moves 3 times the speed of TLT. Okay. So if you think it's going from 95 to 122, which is say here to here, it's So that's so it was 30% actually. Not bad. Let's see if that's so if I'm doing 3x, this assumes it goes in a straight line. If it doesn't go in a straight line, it's not going to be perfectly like that. So if you go 30 times 3, right, that's 60%. Let's go. So I can do about here, right? Let's get more accurate. All right, here, $85. So I could buy TMF at 52, 53, sell it at 85 later on. I don't know how fast it'll get there. It might take a while. That's the annoying part, because if it just does a zigzag, very annoying. You don't want to hold these leverage ETFs that long, more than like a trade. Like if it has to last several months, it better be a smooth line. You don't want the zigzag. It's just going to eat away at your potential gain. So this is just potentially. If it goes up in a straight line, this is potentially where it will be at the end at 85 using TMF. The other way is you take TLT, and CKJ3 is probably going to do this. He's going to take this and take a leap. He's going to buy a leap option. And I'm not going to get into leap options right here in this stream. So this is something you're going to have to do homework on. Leap, L-E-A-P. This is what Nancy Pelosi uses when she wants to do leverage. So look up leap options. So you take this ETF and you try to buy options that last long so that you don't have a delta decay on your option. I'm not going to explain delta, and I'm not going to go to the Greeks and all this right here. This is not the stream for it, but you can look up yourself, look up leap options, look at TLT. If you really think interest rates are going to drop significantly into next year, then you can buy that. That's a really good way to do things. Yeah, $2,000. Okay, so to me, this is really a personal thing. Like if you're aggressive and you want to trade like Dedison does every day and scalp, yeah, 2,000 is perfectly fine for an options trader. If you're not that way, if you don't want to do it that way, like take that 2,000 and wait a while, because I am going to highly recommend Bitcoin miners. All right, this is what you want to be in, because from what I see with Bitcoin, I think that the stock market is going to have a 1994, 1995 to a .com type boom. Like at least it can last at least 2 years. Come on, give me 2 good years. If it can do 2 good years, I would be really considering first going into Bitcoin miners. Like at least like maybe take that 2,000 and 5x it. So that's going to be a 10,000, right? Take that 10,000, take it out in 1 month or 2 months, like maybe at the end of February to March. If you're lucky, you get that, and then start like really gambling hard. Now I don't know about the shit coins. Like you could try to divide it up. Let's say you just divide it up. Like let's say you take maybe 1,500 of that into the Bitcoin miner and save 500 that for gambling in Coinbase with the shit coins. I don't know. You could try that strategy. I don't know much about shit coins and all that aspect, but once we get that last big move up in Bitcoin, yeah, all that trash Dogecoin, like pregnant butt coin, like all the junk, yeah, you could gamble. You could take like $500 of that and just gamble. So it's really, yeah, up to you how you want to do it. Options is definitely a clear way. $2,000, you can try to learn options trading. That's for sure. But when I did things, I had income, right? And if I didn't have income, I took that little money like you had. Like my parents only put $5,000 in Apple stock. And that was a big gain, but you got to be patient about it. And the reason why I'm hesitant in recommending that kind of strategy to most people is that inflation is so bad, and the cost of living and taxation is getting really onerous, that I don't know if that strategy really works anymore, because like you got to get really lucky like I did, because I picked the right ones. I picked Apple, I picked AMD, I picked Tesla. And the reason why I'm doing these streams right now is because I really feel like you cannot rely on a mixture of luck and being born at the right time, because I was born at the right time too. You know, I was born in the right cycles. Like if you were born in the wrong cycles, a lot of people, they started work when it was a downturn in 2008, right? Or they bought like stocks when it was a crash in the 2000 and 2001 times. So it's so painful. But hey, you know what, Chris? Yeah, like the stocks I like to look at is like Palantir and Axon. That's the stuff I like to look at. That's really the stocks I like to look at. Yeah. You got to find stocks like that. That's really what, hopefully I'll try to find these stocks for you. Maybe those $2,000 can have a good home to go to. But if you can't, and you have the time and effort, yeah, you should go to Denison's. So I'm going to put Denison's Discord. So I don't know, maybe you are the right person. It's also a personality thing. I don't think a lot of people, you know, are suited for really risk taking in that sense. Here, you can go Denison. I put the link. I'm trying to find the old chart I did so I could compare the different the different gains you could make on different stocks. Yeah, I mean I did it like last stream or 2 streams ago. Yeah, I keep forgetting. Okay, here it was. All right. Let me put this back up. But yeah, you have options. You definitely have options. And in November, I'm going to start doing more proactive type of streams where I show you, okay, here's a model portfolio. Here's some tickers I have today. Here's what happens if you day trade. Here's what happens if you like. So you can try to gauge from that like how you would perform. Okay, so you pick your style, you pick your journey. Everyone's gonna have to pick their own way to go. All right. So this is what I showed before. This is the S&P 500. Adjusted for inflation using the producer price index PPI. Now, here, let me show you what it looks like if you percent. All right. So I bought Apple, or at least I told my parents to buy Apple when I was in high school, right? But like all the way here, right? In the 90s, whatever, even during the dot-com bust, and I didn't care. It was already going bankrupt in 1998, you know? So look at that. I may, if I held it, I mean, my parents did not hold it all the way through, okay? They did not hold it through COVID and all this craziness that happened after that. But that's nearly 60%. I mean, 60,000% gains. So you can see that. Now, this is the problem. Like, are you going to be born at the right time? And you're going to have capital to invest at that time. So that $2,000 is perfect. $2,000 you buy here in 1998 and you just wait like 20 odd years. Like you're rich. That's cool. But a lot of people nowadays, I think, are going to be skeptical that that's going to work again, because you're going to have to find that perfect stock and you're going to assume that the whole U.S. economy is gonna keep pumping like this over and over again to give you this result. That's the problem, right? Because you had to go through 3 cycles to get up here. You had the COVID boom here. You had like the semiconductor boom here. I mean, this last one's probably due to AI. So this is maybe a next boom, and you missed all of it. Like, you didn't buy here, okay? When things were back in the 90s, when even they had a bubble, but you can't even see it now because that bubble is so small compared to the bubble we're having. So this is why, hard to compare. Now, the most recent ones are like Nvidia, right? You look at Nvidia. Oh, so interesting. So even some guy who bought Apple like me in 1998, 1997, and could make 60% gains over here, still could not beat Nvidia in the last couple years. So from 2022 to 2024, look at how much Nvidia, like if I bought Nvidia way back when, at the same time as Apple, Nvidia is whooping my ass right now. So yeah, this is why so very hard to make it with just a small amount of money. I did, but I just can't really suggest it to everyone because I think there's this amount of luck that's involved that you just cannot replicate very easily. And so with the stuff I'm teaching now with the charting and whatever, I am more in line to suggest that you try to trade your way out of it. You should definitely always consider keeping a small amount of money, hoping that you can pick out something that could make a monster move like Nvidia, Apple, or whatever. Like, there's more. Like, here's another one, CELH. CELH is a beverage company, an energy drink company. And if you bought it at the right time, like you bought it at the wrong time, it didn't work out so well. But let's say you bought it at the right time. You bought it at 2017. You did way better than Nvidia. Of course, now it's dropping like crazy. You see this? So, but it's an energy drink company, and there's so many stocks out there, you know? Like, I was in this energy drink. I didn't believe in it that much. If I knew it was going to outperform Nvidia, shit, man, I would have bought a ton of it, but I didn't. So there you go. Now, let's look at another favorite, Bitcoin. Depending on where you bought Bitcoin, like here, right at the beginning of Bitcoin, like 1,000,000% essentially. If you bought at the wrong time, Nvidia is comparable to the gains of Bitcoin. If you really bought it at the wrong time, well, Nvidia whooped your ass completely. So timing is so crucial. This is really hard. It's not an easy thing. I'm not suggesting it's an easy thing, but I'm just telling you that, you know, if you have a good knowledge base, you can at least attempt to try to improve your odds. So that's the only thing we can do. There's no guarantee that you'll get the perfect hand, right, in a poker table, but at least you know your odds. And with that knowledge, you can try to position your capital. Because look, like Chris Reed said, I got $2,000. That's all I got. Now you really have to think hard. Rich folks, they don't really have to think. They can just spray and pray like a dummy and probably do all right. And that's kind of the disadvantage you have with having limited capital. And I think with $2,000, yes, you should consider going to Denison's Discord. Like, see if options is the better way for you to go with that kind of money. If you think it's too complicated, then yeah, just come here to see what I'm saying and we'll try to figure out another way. But because the way I did it is totally different. Like, I just got a few thousand here and there. You know, you bought Tesla, you bought AMD, you bought Apple at trash prices and just waited 10, years at most. And if you were really patient, 20 years, and you could make out good, right? And you bought Bitcoin at the right price, sure, also. But a lot of people, they don't have that luxury to wait. You got life situations. You might have to pull that $2,000 to pay for something else. It's so difficult because everyone's in a different position. So right now, all this does with this stream is to try to give you as much knowledge as possible this month. I'm trying to build your base of knowledge. Okay. So it's a good time to switch gears, I think. So we don't need this anymore. We can talk about risk management a little bit. So HB, he bought this stock, right? Because I was hyping this stock up for at least the whole summer, talk about Palantir. And when it had this big dip here, with the stock market, this huge dip, that was so risky for him to buy it, but he bought it. He bought it at around 21 right here. It was for a brief moment, right, in time, because it rallied right after 1 hour later. But he got it right at the bottom. Now, where are we at? 41.44 as of closing today. So he's almost nearly double what he bought it at. And the question to most folks is that, when do I decide to sell? How do I decide to sell? It's so hard. A lot of people would just get freaked out. They would just sell maybe randomly. Maybe you decide, hey, I'm just gonna take profits at each point here. Maybe I say $30 is a nice round number. I'll take a profit here, and then 35, I'll take another one, and hits 40, I'll take another one. Is there a better way? Now, the only way I could see is that you respect your resistance. So if it pops up here, over that, I'm willing to say, as long as these trends, so these two lines are the moving averages. I discussed what moving averages are earlier in 2-3 streams ago. As long as they look fairly parallel, I'm using this daily chart, so each candle is 1 day. I'm willing to hold, right? Is there a better way, though? Is that the only way I could decide, man, I'm not going to sell. I'm just going to keep holding. Yeah, FXI crashed. Yeah, I shorted it. I got lucky, but I don't know. I held it, though, Claris. So maybe it's going to rally tonight, and I'm going to lose some of my gains, but I only bet a little bit of money. It wasn't big money. So that's why I'm just holding it. If I bet big money, I would have covered, man. I'm done with it. But that's what you get for chasing bubbles. A lot of these people are just chasing them bubbles, man. Anyhow, back to the example. Palantir, look at it. Perfect. So how do I know when to sell? So that's why we got to go through these articles here. We got to go through these articles. It's going to be painful. I think we're going to go through some math. You guys might start just going to sleep now, I guess. Whatever. What can I do? I got to do it. Maybe Portia can do a better job than me going over some of these things. Okay, let's look at this. Average true range. Are you asleep yet? What is the average true range? Okay, developed by J. Wiles Wilder. Man, what a great name that is. I mean, he's famous. Wells Wilder is very famous in the technical analysis community. So he's one of those forefathers of developing all these techniques. The average true range is an indicator that measures volatility. Okay. What's volatility? So should I describe what volatility is, or should I continue? As with most of his indicators, Wilder designed ATR with commodities and daily prices in mind. Commodities are frequently more volatile than stocks. Yeah, no shit. They are often subject to gaps and limit moves, which occur when a commodity opens up or down its maximum allowed move for the session. A volatility formula based only on the high-low range would fail to capture volatility from gap or limit moves. Wilder created the average true range to capture this missing volatility. Okay. It is important to remember that ATR doesn't indicate price direction, just volatility. All right. I think that's enough here. Now we got to go discuss what a true range is, okay? I think you can look at this picture. Look at this picture here. You see that? So the true range is whatever move something made from yesterday to today, regardless of how it actually moved inside the day. So we're not going to take into account like the body of the candle. So if you remember from the lesson I did, you have open and close, right? So open here, close there, and you have high and low, open, close, high, low, all that. So the true range is just measuring all these possibilities. So method 1, current high less than current low, current high less than previous close, current low less than previous close. So that's it. That's all we got. We can just do all these types of little gaps. We're going to measure it. And the thing that we're doing is that we're going to take all these numbers. So all these intraday numbers here, and then we're going to average them over a period. All right. Hope you're following me. I'll make this big table. So let's look at this chart here. If you look at this quadruple Q, I didn't know there was a quadruple Q ETF, but all right. You see all these candles are pretty close together. They all don't have a very large spread, right? The bodies are small. The range is small. So April 5th, to essentially April 26th, not too much volatility, right? Because the range hasn't grown. The range of movement hasn't grown. And all of a sudden, after the 26th, more and more of the candles start increasing in spread. They're increasing in size, moving bigger and bigger. So we see the ATR just starts increasing as we go. Now, I think that's all you need right now. You just need to know that. Okay, it's just a measure of how wide these bars are growing, how wide the range is growing. You see the wick here, that huge crash in May. You see that one? That just made a huge jump because that wick went all the way down below $42 a share. Now, how do we use this? How do we use this information to try to decide when to sell a stock? Okay, here we go. ATR trailing stops. What is an ATR trailing stop indicator? An ATR average true range trailing stop is a volatility-based indicator that sets dynamic stop loss levels for market exits or entries. This indicator uses average true range, a metric that evaluates market volatility, to determine where the trailing stops will be placed. Now, for you guys that have traded already, you should be aware of what trailing stops are. So I'm going to go to this Robinhood, this basic bitch Robinhood example. Trailing stop order. A trailing stop order lets you track the price of a stock before triggering a market order if the stock reaches the trailing stop price. With a trailing stop order, the trailing stop price follows or trails the price of the stock by a trail that you specify. If the stock's price moves in a favorable direction, the trailing stop price will move with the stock. If the stock's price moves in an unfavorable direction, the trailing stop price will stay the same. Okay, that's a lot of mouthy words. We need an example. Let's do the sell trailing stop order. With a sell trailing stop order, the stop price follows or trails the highest price of a stock by a trail that you set. If the stock falls below its highest price by the trail or more, you sell. The trailing stop order becomes a sell market order, and the stock will be sold at the best price currently available. Okay, you guys, hold on here. Listen carefully. Here's an example. Let's say you own a stock, YOWL, YOWL. I don't know why they picked this one. You think YOWL will rise in value, but want to help protect yourself in case it falls in value. If you set your trail to 5%, your stop price will always remain 5% below YOWL's highest price. YOWL is currently trading at $100 per share. Your stop price will start at $95, which is 5% lower than the current price. Okay? Get that? If YOWL stays between $100 and $95, the stop price will stay at $95. If YOWL rises to 110, the stop price will update to 104.5, 5% below the new highest price. So the problem with this is that you fixed what percentage that you want to sell it at. Every time YOWL makes a new high price, you're always considering to sell it at 5% lower than that highest price. But if the volatility switches up on you, do you think that 5% is the correct price to sell it at? That's my question to you right now. What's the risk you're willing to take here? If you're willing to take more risk and the volatility increases, you should allow the price movement to breathe. If you hate risk, maybe you should be tightening up that percentage, and you shouldn't be using 5% anymore. So this is where this comes in. So back to here, what is the ATR trailing stops indicator? The ATR, average to range trailing stop, is a volatility based indicator that sets dynamic stop loss levels for market exits or entries. So that's the key. The previous example with the Robinhood, and most brokerages will do this. You just set a percentage, or you set a price rate where you said, like, okay, I subtract a certain price. So that's even worse than a percentage. That's even worse. Oh, so Link Little asked about IoT. I heard about Samsara, actually. I've seen their buildings around. I think I looked at their stock a couple times, but I did not pay attention. Was there something interesting that I should be looking at in the news? No. If not, I'll put that on my watch list to look at later. So the next time we meet here, I'll talk about IoT. Because, yeah, I know about that company. I've seen it around. I've looked it up. Yeah, the chart doesn't look bad. So definitely I'll look into it. What will be more advice? Yes, see, so that's what I'm getting into, J Rose. So this is what this ATR will help you with. So this has nothing to do with percentages or absolute prices. So we will actually use the volatility of the stock to adjust it dynamically. So let's look at how we can do this. So the ATR trailing stop calculation requires a few steps. They are as follows. Calculate the ATR. So I covered that in the previous article, the first one here, right? Average true range. You can look it up yourself. and there's different computations. But after you figure that out, we can just go through an example. The ATR is a moving average of the average true ranges, right? The true ranges over a specified period. Average true range. That's all it is. And you can set how many days you want to average it. Then you multiply that number by whatever factor you choose, okay? So this is what's going to happen. If you're very aggressive, you're not going to pick 2, 3, 4, right? You're probably going to pick like 1 or 0.5. Who knows? But the problem with that is that you might get stopped out too early. So you got to, I think this is a personal matter a little bit. And maybe you're going to have to do some trial and error. I think there's probably a better way to do this nowadays, because we have so much data, we have so many charts, we can probably do a better job than just randomly picking a factor, because most people pick 2 or 3. I don't know why. That's just a rule of thumb, I guess. And then after that, you can figure out what your loss is just by taking that ATR number that you got, multiplying that number, and then subtracting it from the last highest price. Okay, that's when you want to use it to get out. And each day you got to update it manually. That's the problem. If you do like that 5%, you don't need to change nothing, right? The broker already sets 5%. It's going to adjust it for you. But you doing it this way, now you got to figure it out from the chart, update it every day. Pretty annoying, I would say. I think maybe if you look at Thinkorswim, so if you're using TD Ameritrade, Charles Schwab, maybe you can set this through their script in Thinkorswim. You're going to have to add, I never used it myself, Thinkorswim, but I'm pretty sure you probably can. So you probably could write your own script to automatically set these at closing of every day in the Thinkorswim platform. So yeah, talk to someone else who's really into Thinkorswim. I think both Dennison and CKJ3 use Thinkorswim. So if you need more advice, you can ask them whenever they're on panel. I think we need to get a list of people's questions and things, and we just send it to them so they answer it in one fell swoop. So let's look at this Investopedia article. Let's see what they say about it. Blah, blah, blah. Yes, we know that there's a volatility. Yeah. We don't need that. So let's look. Understanding trading with ATR. So this is a basic article that they would just give to everyone. The question traders face is how to profit from volatility cycle. While the ATR doesn't tell us in which direction the breakout will occur, it can be added to the closing price, and the trader can buy whatever the next day's price trades above value. The idea is shown below. So so you can use this to buy, because if it's trading higher than the ATR, you can initiate a buy. We're interested in getting out though. So here we are. ATR exit sign. Traders may choose to exit these trades by generating signals based on subtracting the value of the ATR from the close. So this article tells you to subtract it from the close. The other article told you subtract it from the last major high. So you see, it's getting nuanced now. You can decide how you want to use this ATR. So the ATR gives you that volatility measure. You multiply it up by a factor, and then you can decide, okay, if the stock is getting more volatile, I can choose to ride it though. Like even if it looks getting more and more scary, like, FXI, right, is doing with China, I'm still going to hold to my long position if it meets the criteria. Because if you quit too early, you missed a lot of the moves of that pump up in China. Okay. The use of ATR is most commonly used as an exit method that can be applied no matter how the entry decision is made. One popular technique is known as the chandelier exit. Oh, I heard of that. Chandelier exits. Was developed by Chuck Lebau. The chandelier exit places a trailing stop under the highest high the stock reached since you entered the trade. Okay, so the highest high there is what they consider the chandelier. All right. The distance between the highest high and the stop level is defined by some multiple times ATR. That's what that other article was talking about then, the chandelier. So you can do it the dumb way with the close, or you can do it with the highest high that you previously saw. Okay. I think that's it for the trailing stop. So let's go back to the chart and try to come up with a stop loss for Palantir right now. So yeah, little. So this is IoT. I was looking at it. Yes, I like the way this chart looks. Yes, I know about this company. I've seen it. Definitely wait. Let's see if it pulls back, because this is a very strong chart right now. You know, like VST is another one I've been looking like. I was like, look at this one. This is crazy, right? So this is a utility type of stock with focus on uranium and AI. So I think this drop is following uranium right now, because uranium is hitting. So the uranium miners is hitting a level here. So this move right here is probably stretched. Wait for it to pull back, figure it out from there. Let's see how it goes. So IoT, I would be looking at the same way. Like it's pretty stretched right now, but I'll keep an eye on it for you. All right. And one last stock I wanted to mention was Mind Medicine. So MNMD. This one is a mushroom acid psychedelic research company. It got FDA approval, which is why it rallied back here in March. It's pulled back, so now it's within range between 3.5 and 5.7 area. I'm definitely looking into buying this again. Yeah, if you got a full IRA account, definitely. The other one is our body cam. So this is my favorite stock, along with Palantir. It's very stretched. I would not buy it here. I don't know if I'm going to sell it like in Friday or not. Like if the stock market does look kind of like it's going to implode, yeah, I'm probably going to get out of here before elections or something. But you know, as a long-term stock, you don't need to really sell it. You probably don't care because you bought it here. But still, it's like, I don't know. That's always the problem. You got to consider about taxes. Once you sell, you're gonna have to pay taxes, right? And that's where like people use options. So that's where options is not for gambling. All right, options was like for people holding stocks or shorting stocks for over multiple periods of quarters, and they would use options to kind of create an insurance package. Yeah. So what was that last stock called? So I don't know which last stock was that. Let's go back. So this one's Axon, AXON, body camera. The next one was MNMD. That's Mind Medicine. Okay. And then this one, Link Little told me to look at Samsara. I heard of this stock. I only paid attention to it probably twice in a couple years. So definitely I like the look of this chart. So I will investigate further. I mean, you could tell right away. Look at this. So whatever happened in IPO or when this thing started trading, it touched it a couple times. It bounced off support and just rallied off of it. So this is perfect. It's a beautiful looking one. Whether or not it continues up remains to be seen. So I'll have to investigate further. But it hasn't been trading that long. Okay, so that's good. So let's go back to Palantir. This is the one we're going to look at for an example here. How do we decide our stop loss? So we're going to use the ATR, all right? We're going to try to figure out, hey, So this is my ATR here, and I'm gonna be a little fancy. So I have the ATR here, 40 ATR. So I'm gonna do the daily now. I'm gonna switch to the daily. Here's a daily chart. I do 40 of them, 40 days, and then I have an 18 moving average. So I smooth out all the noise. So I'm just gonna look at what the average is, okay, guys? That's what it is. I'm not gonna pay attention to like the big pumps and all this. I'm just gonna try to get the average. So for the most part, since HB bought it, it was at 1.07 was the average ATR, and then it's plateaued to about 1.3. Okay, so since this time here, after it regained its footing, the ATR is 1.3. So the volatility of most of that up leg that HB was in is 1.3. So let's say we got 1.3. We take that 1.3 and multiply it by 3. I'm just going to assume HB is willing to hold it even if it drops like crazy. So let's do 3 as a factor. So if you take 3 times 1.3, that's 3.9, right? 3.9 is close to 4. So we'll round it up to 4. So we'll take the price of 4. So the last major high is today. Today we made a new high at 41.49. Okay. So let's take 41.49 subtracted by 4. So now I'm going to set my stop loss at 47.5. So pretty close to that purple line I drew here. So I think if HB for the rest of the week saw that this thing was staying about above that purple line at 37, he could just hold it, no problem. Now, if it cuts right through it and closes, so it ends the day below this purple line in the next coming days, maybe HB would probably say, I think I'm gonna sell it. I'm done with it. So that's one way to do the stop loss, because you're just taking the average range and try to use a volatility to say, hey, I'm going to sell it just based off of that. I'm not going to do an arbitrary like, 10%, because you could have probably stopped here. You probably would have been out long ago if you just did something arbitrary number, right? Who knows? Arbitrary price number or arbitrary percentage. It would have been too restrictive. Let's put it that way. So this way you use the ATR to try to say, hey, you know what? I'm willing to ride this as far as I can. All right. So that's good. That's one example. Now, I think that covers the lessons for today, but I want to close it by talking about risk premium. So John was talking about risk premium in terms of his tenants, right? So like which tenants had more risk than others. And the concept is well known in stocks. The way people do it is that they try to compare whatever they're doing with a 10-year bond. So the risk of a 10-year bond compared to a risk of something else. I think I have to give you some introduction into the 40-60 bond market. Let's see. Yeah. I mean, not bond market. I mean, the 40-60 portfolio. I mean, I think a lot of you have heard of it before. but just in case you haven't heard of it. Here's a PDF. A brief history and outlook for 60/40 investment portfolios. Let's look. StreamYards doesn't see it. Oh man, very annoying. Okay, here we go. All right. Make sure you can still hear me. All right. So that's the PDF. A brief history and outlook for traditional 60/40 investment portfolios. One of the most common investor portfolios we see utilizes an allocation that funds 60% of investable assets into stocks and 40% into bonds. These so-called 60/40 portfolios are typically rebalanced at the end of each year to reestablish their target ratios. Although they are used by individual and institutional investors alike, the advent of exchange-traded funds has made it especially easy for individuals to further diversify both sides of the equation to also include global stocks and bonds, real estate, and commodities. So that's the key I'm trying to get to you with this stuff. So in the old days, most people didn't have these ETFs. They were locked into funds set by the mutual funds that they were given, and most of them weren't really anything special. They are some form of 60/40 style portfolio, and based on your age, it would just adjust it accordingly. They would put more into bonds and less into stocks. Very no-brainer way of doing things, because what they found was that the 60/40 portfolio was the most optimal in most cases, in most market conditions. Let's put it that way. So let's continue here. These portfolios are often presented as suitable for clients with moderate investing objectives, reducing the risk of investing in stocks alone. This has generally held true during the last 40 years. Why is it then that countless market professionals have recently heralded the death of these ubiquitous 60/40 stock and bond portfolios? So are we reevaluating the 60/40 strategy? Why are we reevaluating these strategies? I mean, there has to be a reason. There was a reason, and that reason was called 2022, I believe. That was when both stocks and bonds completely shit the bed. I think I have a nice graph of that somewhere. Yeah, here we go. A reader asked, can you please explain why financial media personnel keep saying that 60/40 is dead, but they are not saying target date funds are dead? Last year was one of the worst years ever for a 60-40 portfolio of U.S. stocks and bonds. These are the 10 worst calendar years returns for a portfolio comprising of S&P 500 and 10-year treasuries going back 1928. So the worst years ever for a 60-40. So 60% stocks, 40% bonds, okay? Specifically, you just index it to the S&P 500, 60%, and 40% you put in 10-year bonds, all right? So there are some select years here that were pretty bad. Great Depression, 1937 crash, but here we are. 2022, negative 17.9%. So it's a nearly 18% loss. And it's third place for being the worst year for this strategy. Now, here's the question. Was this a one-off? Or should we really just be considering that, hey, guys, you should be doing better than this? Because I can't be withstanding another like 18% loss, right, in 1 year. So this is why we're gonna have to go back here. Why a 60-40 portfolio is no longer good enough. Now, I mean, I don't want to be a doomer, but I will just say this, that you should always look for better alternatives. You know, sometimes doing something that was always done in the past isn't always going to work out because paradigms have shifted. But we'll see. You know, 60-40 has worked pretty well for many, many years. It's hard to break that dogma. For many years, a large percentage of financial planners and stockbrokers crafted portfolios for their clients that were composed of 60% equities, 40% bonds, or other fixed income offerings. And these so-called balanced portfolios did rather well throughout the 80s and 90s. But a series of bear markets that started in 2000, coupled with historically low interest rates, have eroded the popularity of this basic approach to investing. Some experts are now saying that a well-diversified portfolio include more asset classes than just stocks and bonds. As we'll see below, these experts feel that a much broader approach must now be taken in order to achieve sustainable long-term growth. So what did I talk about last time? Last time I said commodities, right? I was telling you commodities. And this presentation, I've also clearly stated that I hate dealing with commodities for a lot of reasons, because they like to pump and they like to dump the next day. It's just like very annoying. However, you saw that last article talk about ETFs. I think I could make an ETF portfolio, a very boomer-like portfolio that can beat this 60-40. Just with the techniques I'm telling you now, if it's possible. Hopefully in November, I'll start doing this. I'll give some model portfolios for people to follow. And I'll say, like, let's keep track of it. Can I beat the S&P 500? Can I beat the 60-40? Let's see. This is the goal. First objective, beat the S&P 500 by itself. Second goal, beat the 60-40 boomer basic bitch portfolio. If I can do that, and I can prove that I can do that, then there's no question in my mind that any of you guys could do better than even me. Okay? And I think that's what has to be proven right now. Because if you don't believe that, then you should not listen to anything anymore, and just believe that if you just do 60% S&P 500 and 40% bonds over the long term, you should do well. This is the problem. Can we say that it's going to be true for the future, though? It was true for the past, but the past isn't the future, right? All right, Bob Rice, the chief investment strategist for boutique investment bank Tangent Capital spoke at the 5th Annual Investment News Conference for Alternative Investments. There, he predicted that a 60-40 portfolio was only projected to grow by a rate of 2.2% per year. Bruh, if you're only going to give me a guaranteed 2.2%, I can't beat inflation with that shit. If inflation is sticky at 3 to 4%, I'm just barely like holding my actual capital to buy my groceries. Are you serious? All right. And those who wish to become adequately diversified will need to explore other alternatives such as private equity, venture capital, hedge funds. Dude, bro. And none of us are going to be doing private equity. Do you have millions of dollars lying around ready to go? No, I don't think so. Venture capital? Hell nah. Hedge funds? You can't afford their fees. Timber? Collect? Like, what does that mean? Bro. Duh. So, this is pretty damning, I would say. So, if I got to go to this extreme just to get better than 2.2%, I'm in trouble. I'm really in trouble. So Rice listed several reasons why the traditional 60-40 mix that had worked in the past few decades seemed to underperform. Due to high equity valuations, monetary policies that have never previously been used, increased risks in bond funds, and low prices in the commodities market. Another factor has been explosion of digital technology that has substantially impacted the growth and operation of industries and economies. You cannot invest in one future anymore. You have to invest in multiple futures. The things that drove 60-40 portfolios to work are broken. The old 60-40 portfolio did the things that clients wanted, but those two asset classes alone cannot provide that anymore. It was convenient, it was easy, and it's over. We don't trust stocks and bonds completely to do the job of providing income growth, inflation protection, and downside protection anymore. Oh man, what a damning thing to say. Are you telling me I can't just be dumb and just do what those people at Charles Schwab tell me to do? So, in any case, you guys can read this article, right? I gave the link. Yeah, you gave the link. You guys can read that yourself. You can read all this other stuff. Now, this other one's pretty interesting. This one's a pro 60-40. So I'll continue with this one. So just in case you don't believe that other dude, you can read this one. By my calculations, 2022 was the third worst year for a diversified mix of stocks and bonds over the past 95 years. That's pretty bad, but it's 1 year. Bad years happen for every asset class and strategy. They're called risk assets for a reason. 1 year does not a successful strategy make. Some in the financial media have been pouring dirt all over the 60-40 portfolio, just like the article I just read, right? It's broken. It's not going to work going forward. Correlations for stocks and bonds are higher when inflation is higher. Ditch the simple and go with the complex. I think the simple part irks many people in the financial media investment industry. Complicated gets more clicks and eyeballs. Complex is easier to sell than simple. The media has been planning for the funeral of 60-40 portfolio for years. June 29, 2017, the way Wall Street has taught you to invest for the past 60 years may be dead. June 14, 2016, the 60-40 portfolio is dead and it's not coming back. November 9th, 2015, 60-40 stock and bond portfolio is dead. Okay, November 16th, 2014, investment managers are ditching 60-40 portfolio in favor of more liquid alternatives. Oh, November 27th, 2013, investors are sticking to the 60 portfolio rule, likely to get badly hurt. And 2012, why balanced portfolios may not work. So anyway, you can see like there's a lot of opinions, right? I don't know. You think I know? I'm not a financial advisor. I can't tell you that. What I can tell you, though, is that what I've seen and what I've shown for the past few presentations is that you can at least try to time the markets. It's possible, but it's not guaranteed. The question is, can that level of experience give you that edge to allow you to build a portfolio that will beat the 60-40? Right? That's the question. Because I know a lot of you guys, you know, you want to beat inflation now. Inflation is high. That's one reason I've come in to tell you this stuff. If I believed inflation was going to get tampered down, I wouldn't do this. But I have a feeling that inflation is going to stay and remain high for the foreseeable decade, because we have left the era where China is the world's factory. Once you leave that era, the era that I grew up in, the 90s to the 2000s, it's no longer there. So globalization, giving its nice deflationary effect, is going away. The second reason is that, you know, everything is a competitive, global competitive market. We are not isolated as we once were. You are competing with many people, not only, you know, migrants inside the country, but people outside the country. Your labor now is priced on a global scale. You won't get higher wages. Okay. And these are problems. These are systemic and structural problems that are going against you that I didn't have to face. So I could just stand back and be like, whatever, 60-40 portfolio, or do this and that, wait 20 years and I'll get my, you know, gains. But those gains, when you take into account all the losses you're facing and taxation as well, and I will assume that taxation is not going to be improved, because a lot of the current middle class is pushed up to a bracket where you're going to get taxed higher. So when my parents were quote unquote in the middle class, like $60,000 to $70,000 to $80,000, when my parents retired at $90K with overtime, that was good enough to buy a house, get a bunch of cars, do this and that. They were fine. They were comfortable. But for that same 60, 70, 90K now, it's like equivalent of 150K. And if you're looking at California, I would probably say that's like 180K or 200K. That's ridiculous. So when I retired, you know, I basically quit. It wasn't really retirement. I just said, F this shit. I'm not doing corporate crap anymore. I was probably, with bonuses, I was probably making over like 160K, right? And that was just before COVID hit. If I stuck around, I probably would have got like 200 G's by the end of it. But it's just like, yeah, that kind of money really, I think, wasn't going as far in California, you know, because of the way, you know, your tax brackets are set up. And it's just ridiculous. It's just ridiculous. And you have the gas prices in California are very high. You know that everything's very high. Even public transportation is quite high here. So you're paying the cost. You are paying that cost. In any case, this is the whole crux of the matter. How can we beat 60-40 to a degree that it's worth the risk? That's really the problem to make. So I'm going to end it with I don't think I can get to the silicon crucible. That stuff is going to take too much time. I think I'll just end it here. Calculating the equity risk premium. Okay. And maybe a sneak preview of the next set of things. Man, this thing doesn't close. Oh, good Lord. Oh, yeah, it's an archive. That's a version. That's why. Okay. So I can close it here. Equity risk premium is a long-term prediction of how much the stock market will outperform risk-free debt instruments. Recall the first steps of calculating risk premium. estimate the expected return on stocks, estimate the expected return on risk-free bonds, subtract the difference to get the equity risk premium. Okay, I think it's pretty simple. I think the problem though is that, like, how do you estimate the returns? Like, can you predict the future on stocks? You can kind of predict the future on bonds, but even that is put under question. Because as you saw in 2022, when the interest rates started getting jacked up by the central banks, those guys who stayed too long in bonds got shafted. So even the so-called risk-free bonds aren't really risk-free. So this is a problem here. How can you do it? So I'll just loosely grow over this. Like, let's just go over this very loosely. Estimate the expected total return on stocks. Whoa, good luck on that. How do I know how stocks are going to do in the future? Earnings-based approach. Well, okay, we just do earnings per share over stock price, all right? And the dividend, so assuming the dividend stays the same. So let's say a stock has a dividend, the dividends a share and the stock price and some G factor, which is the growth in dividends. Wow, all right. Yeah, I think this is pretty tough to do. Like, I don't know how would you model this correctly. You're just gonna if you're gonna go by the past data, that's not enough. You need the future, right? What's the future earnings per share? Like, if I don't know that, why would I even bother with this? So this is tough. This is really tough. So we can go over this, right? That's just one way. So you got the dividends and you got the earnings per share. So I'll show this briefly, and we can start with this the next lesson. Now, I think what's interesting is that you have many ways to try to figure out what the rate of return is. So let's jump to step 3. So I'm going to skip all this stuff, because we're going to go over this again later in the next stream. Subtract the estimated bond return from the estimated stock return. Okay. So let's say we could figure out the future and say, hey, I know what the bond return will be and the stock return will be. When we subtract our forecast of expected bond returns from projected stock returns, we get an estimated equity risk premium of 2 to 3%. That means your stock investments need to gain at least 2 to 3% to justify the risk of owning equities versus staying parked in risk-free investments. So if you're not sure your stocks are going to go above 2 or 3%, well, forget it. Just stay in bonds, I guess. So that's what this is telling you. Now, here is something I will definitely cover next time. I found this website like last night. I just Google searched, and I thought this was this old website from probably some dude's like course in Stanford here. Like, it looks like it's a probabilities course, and I thought this was very interesting. Very interesting. So let's say you had equal probability of good weather and bad weather. All right, 50-50, right? Okay. Now, what's our expected returns? What's our expected returns? Good weather, bad weather. So let's say I have a stock. When we have good weather, it's going to give me 26% returns. If it's bad weather, I'm going to drop 4%. Okay, I got that. I got 50-50 chance of good weather, bad weather. I got a return of 26% if it's good weather, negative 4% if it's bad weather. All right, got that. Now, bonds gives me 5% good weather or bad weather. It doesn't matter. It always gives me 5%. So now you got this little matrix here, right? I think this is a very good example. You got the negative 4%, you got the 26%, you got the 5%. Now Let's add it all up, because now we can multiply each of these numbers by 0.5 to get 50%. And we can get what we have when we have a 60% stocks and 40% bonds. All right. So if you follow me, you're going to multiply everything up by 0.5, right? For good weather, bad weather. Then you're going to multiply again, because you're going to say like, oh, 60% is stocks and 40% is bonds. So in total, I lost 0.4% if I had a 60-40 stock bond portfolio in bad weather. And I had a gain of 17.6% in good weather. So I reduced my losses in the bad weather. I reduced my gains in the good weather. But because my losses in the bad weather is so much smaller, I'm willing to take the hit in the good weather just by having a 60-40 portfolio, right? Boom, there you go. That's why 60-40 portfolio, quote unquote, works. Assuming that's the probabilities. Now, this is what I'm going to try to do. I am going to try to do where we learn charts, right? Because we know the charts. Can we use the charts to create models of probabilities of stocks, commodities, sectors? Can we improve on this 60-40? So that's my goal. Now, I'm going to need some people that are way better at me than math. So, I need Portia, like John. John can help me. Somebody can help me. And somebody that can do some programming. But I need to figure out a way that if I look at a chart, I can look and decide, hey, this is the risk premium for this sector. This is the risk premium for this industry at this point. And I could figure out how to allocate it more precisely than just bonds and stocks. That's just too simplistic. So 10-year treasury yields, and then I have a S&P 500. That's too. Can I just break it up into the sectors, industries, and different types of bonds? You got municipality bonds, you got emerging market bonds, you got all type of bonds, right? So if we could just like have the probability matrix of every bond, every stock, and just figure out the most optimal way of constructing a portfolio at every given quarter, hey, I think that's something. But that's probably a hedge fund type thing. But so far, let's just first keep it simple. Just work on basics. Let's just try to look. And that's why I told you guys to do your homework from last week. I'm going to put the homework again. All right, put the homework back up. Please do your homework. Read 12 pages. All you got to read is 12 pages. And if you read it, just read it again. Like, seriously, I think a lot of this stuff is the application of skill, not just the acquiring of knowledge. You can acquire all the knowledge you want, but if you don't actually apply it to something practical, it's wasted, right? It's wasted effort. So please go look at the PDF, guys. Anatomy of a Trading Range by Jim Forte. All right. Just read it. Just read the PDF. That's the homework. Don't do. We're not going to do anything else besides that. If you just read it, you will understand the Wyckoff method. You try to look at the patterns. Okay, look at these patterns. I've given some examples in the previous stream with the Hang Seng, the Chinese market. So, and SMCI, I think I gave a distribution, sort of. I didn't go over it with any detail, though. But I think if you read this paper and you see what I did, you'll understand. But all right, guys, we're almost at 3 hours. I'll see you guys another time. It's been swell. Thank you.